with respect to the economy, I think all of us have been surprised over the course of the last year with how resilient the economy has been, with growth really performing above trend. And I think it surprised most forecasters how strong it's been. And I think a lot of that really came because of the strength in the consumer overall. And when we look at the labor market, generally, I still see it as being too tight, but we have seen some important cooling in the labor market over this period. I mean, job growth is still above trend, but job openings have stabilized, but still at an elevated level. We've seen the quits rate and other metrics of the labor market start to come down, but they still have some ways to go. And importantly, wage growth has cooled some. We were seeing wage growth at around 5%, but that has really, through a variety of metrics, come down to look more like 4 to 4.5%. So we've seen some progress with respect to the tightness in the labor market. Looking at inflation, we did get a string of better data, so we got some welcome news over the course of a few months, but the most recent reading was high. And when I take a step back and look at the inflation readings more broadly, it still looks like we're trending toward 3% as opposed to 2%. And when we look ahead, my expectation is that growth will start to slow, but we thought growth would start to slow before and been surprised by the overall resilience. So I think that we're going to continue to need to see tight financial conditions in order to bring inflation to 2% in both a timely and sustainable way. So that brings me to the second question is, what are we seeing with respect to financial conditions? And really since the middle of July or so, we've seen a tightening in conditions that's really been driven by a pretty significant increase in long-term interest rates, with the 10-year Treasury yield moving about 100 basis points higher from about mid-July and until the end of October. And for me, the key question with that increase in interest rates is, what was driving that reassessment in that rise in rates? And if market participants were seeing the economy to be stronger and rates were rising on the back of stronger economic growth, then the FOMC would have to deliver upon those expectations for the average level of the policy rate to be higher over time. But if that rise in long-term interest rates was really driven by term premium or the compensation that investors want for risk, then that rise in interest rates could do some of the work for the FOMC as opposed to an increase in the overnight policy rate. So as we were going into the most recent FOMC meeting, I thought it was appropriate to hold rates at that time because I thought it would be important for us to take the time to assess the implications for the rise in interest rates and whether that increase would be persistent over time. And since the most recent FOMC meeting, we have seen some retracement in that 10-year yield and financial conditions. And so I'll be watching to see whether that continues and what that means for the implications of policy. So importantly, I'm going to be looking at the data and I'm going to be looking at financial conditions as we get closer to the following meeting.